if silver touches $100 before 2026. It won't mean the system is winning. It will mean the system is under pressure. Most people will celebrate the price. Very few will ask why it had to go that high. Silver doesn't spike quietly. When it moves as fast, it's usually because something behind the scenes is cracking. A $100 silver price wouldn't break records first. It would expose weaknesses that were already there. The real story isn't who profits from $100 silver. The real story is what stops working when it happens. If silver crosses $100 before 2026, it won't simply represent a strong market rally. It will signal that deep pressures inside the global financial system are surfacing faster than expected. Silver has always been more than a metal. It sits at the intersection of money, industry, and trust in currencies. When its price moves aggressively, it reflects stress building beneath the surface, not just rising demand. This discussion is not about forecasting prices or promoting speculation. It is about understanding what a $100 silver price would expose, strain, or outright break across financial markets, supply chains, and policy structures. The focus is on consequences, not excitement, because when silver moves that far, something else is already failing. Where the stress begins when silver moves toward extreme price levels. The first pressure point is always the gap between physical silver and paper silver. On paper, silver appears abundant, futures contracts, options. In reality, these instruments represent promises, not metal. The higher the price climbs, the more those promises are tested. A rapid move toward $100 does not encourage selling a physical silver, it does the opposite. Holders of real metal become reluctant to part with it, especially when price strength is driven by instability rather than growth. This tightens availability just as demand increases, widening the imbalance between what exists on balance sheets and what can actually be delivered. Paper markets depend on confidence and rollover behavior. Most contracts are never settled with metal. They are closed or rolled forward. That system works only as long as participants believe delivery is possible if demanded. When prices surge too quickly, that belief weakens. Even a small increase in delivery requests can strain inventories that were never designed to handle mass withdrawals. As this imbalance grows, price discovery becomes distorted. Futures prices may rise sharply, but premiums on physical silver begin to detach from spot prices. Delays, rationing, and higher fabrication costs appear. This is not a sign of a healthy bull market, it is evidence of structural stress. At this stage, silver's price is no longer just reflecting supply and demand. It is reflecting trust, and trust is far harder to maintain than liquidity. This is why the physio-paper divide is always the first crack, before banks, governments, or currencies feel the strain. The silver market quietly reveals that too many claims were built on too little metal, bullion banks, and the short exposure trap as silver approaches extreme price levels. Pressure shifts from the metal itself to the institutions that dominate its pricing. Bullion banks play a central role in the silver market, often acting as market makers, hedgers, and counterparties. To function smoothly, this system relies on controlled volatility and predictable price behavior. A rapid move toward $100 disrupts that balance. Many large players carry significant short exposure, either directly through futures and swaps or indirectly through structured products and hedging strategies. These positions are manageable when prices move gradually. When silver accelerates upward, losses expand faster than risk models anticipate, margin requirements increase, collateral demands rise, and liquidity becomes more valuable than yield. At this stage, the issue is not insolvency, but confidence and containment. Banks are forced to reduce exposure, close positions, or hedge at increasingly unfavorable prices. This defensive behavior adds fuel to upward price pressure, creating a feedback loop where risk reduction itself pushes prices higher. The danger lies in concentration. A small number of institutions control a large share of silver-related derivatives. When even one major participant steps back or changes behavior, market depth thins rapidly, volatility spikes, spreads widen, and price movements become less about fundamentals and more about risk avoidance. This is where stability begins to fracture, not through a sudden collapse, but through hesitation. When banks prioritize balance sheet protection over market function, liquidity becomes unreliable. In a market as small as silver, that shift can turn stress into acceleration, making $100 not the end point, but the signal that control has been lost. Industrial demands shock and supply chain strain, unlike gold. silver is not held only for wealth preservation. It is deeply embedded in modern industry. Electronics, solar energy, medical equipment, defense systems, and advanced manufacturing all rely on silver for its unique conductive and chemical properties. When silver approaches $100, the problem is not just cost, it is continuity. Industrial users do not buy silver for speculation. They buy it because there are few practical substitutes. A rapid price surge forces manufacturers into difficult decisions, absorb higher costs, pass them to consumers, or reduce production. None of these options are painless, especially when silver is a small but critical component in high-volume products. At elevated prices, suppliers begin prioritizing availability over long-term contracts. This leads to shorter agreements, spot purchasing, and competition between industrial buyers and investors. As a result, delivery timelines stretch, inventories thin, and procurement becomes unpredictable. What begins as a price issue quickly turns into a supply issue. The impact ripples outward. Higher silver costs raise input prices across energy, technology, and infrastructure sectors. These increases compound existing inflation pressures rather than replacing them. For industries already operating on tight margins, silver becomes a bottleneck rather than just another expense. This is where silver stops behaving like a commodity and starts behaving like a choke point. When industrial demand collides with investor hoarding at extreme prices, the strain is no longer confined to markets. It moves into factories, supply chains, and national production. Priorities making the consequences far broader than most expect. Currency stress and the inflation feedback loop *** when silver accelerates toward $100, it sends a message that extends far beyond the metals market. Precious metals do not rise sharply in strong currency environments. They rise when purchasing power is being questioned. In this context, silver becomes a signal of currency stress rather than a cause of inflation. As silver prices climb, they reflect growing distrust in fiat stability. Investors, institutions, and even industries begin seeking assets that cannot be created through policy decisions. This shift does not require panic to be effective, only doubt. Once confidence weakens, capital moves defensively, reinforcing the very pressure it is trying to escape. This creates a feedback loop. Higher silver prices highlight inflation concerns, which then drive further demand for hard assets. Policymakers respond with tightening, easing, or messaging, but each response carries tightening risks, slowing growth, easing risks, validating inflation fears. Silver responds not to words, but to outcomes. The challenge is timing. Currency stress often builds quietly and then surfaces suddenly. By the time silver approaches extreme levels, the erosion of purchasing power has already occurred. What the price reveals is not future inflation, but accumulated damage from the past. At this stage, silver's role shifts again. It becomes less a hedge and more a barometer. A $100 price would suggest that markets are no longer confident in stabilization efforts, and that trust in currency management is weakening faster than officials are willing to admit. Once silver approaches $100, investor psychology becomes a dominant force. Early buyers are driven by momentum and fear of missing out FOMO, pushing prices higher as speculation spreads. However, this phase is fragile. It relies on continuous participation and confidence that gains will continue. As volatility increases, sentiment shifts quickly. Latecomers who entered at higher prices may panic when short-term corrections occur. Simultaneously, large holders of physical silver may choose to hoard rather than sell, reducing market liquidity. This combination of buying pressure, selective selling, and restricted supply accelerates price swings, making the market far less predictable. The danger here is self-reinforcing. *** fear drives action, and action drives fear. *** small shocks can trigger outsized reactions, while traditional risk management strategies fail to account for extreme momentum. In this environment, $100 silver is not just a number, it is a point where psychology and market mechanics collide, creating rapid, sometimes uncontrollable, price movements. Extreme moves in silver inevitably draw the attention of regulators and governments. Authorities are tasked with maintaining market stability, but interventions at this stage are complex and often reactive rather than preventive. Options include margin adjustments, temporary trading halts, or limits on certain contracts, but these tools can only do so much. The problem lies in timing and scale. Silver is a relatively small market compared to global equities or bonds. but its leverage through derivatives and ETFs is significant. Any attempt to rein in prices may inadvertently trigger liquidity shortages or force large participants to close positions abruptly. History shows that regulatory action rarely prevents volatility. It often shifts it elsewhere. Interventions may calm short-term panic, but can create uncertainty about fairness, transparency, and execution. This uncertainty feeds back into investor behavior, industrial decision-making, and currency markets, amplifying stress rather than resolving it. In essence, when silver approaches $100, governments and regulators are pushed into a delicate balancing act. The response or lack of one can determine whether the market stabilizes or spirals further, highlighting how interconnected price, policy, and perception have become. When silver nears $100, the effects are no longer isolated to the metal itself, they ripple across the entire financial system. Silver may be smaller in market size compared to gold or major equities, but it is deeply interconnected through derivatives, ETFs, and institutional holdings. Stress in silver can trigger volatility in broader markets, often in unexpected ways. Banks and investment funds with exposure to multiple asset classes may face margin calls or forced portfolio adjustments. Liquidity pressures in silver can spill over into gold, platinum, or even bond markets as investors scramble to cover positions or move into safer assets. The sudden reallocation of capital can amplify volatility, creating feedback loops that affect equities, currencies, and commodities simultaneously. Global trade and industrial supply chains are also impacted. Countries that rely on silver imports for manufacturing or technology face cost shocks and potential production bottlenecks. Exporters and manufacturers adjust pricing or sourcing strategies, which can ripple through global inflation metrics and economic stability. In this sense, $100 silver is not just a local market event, it is a systemic stress test. It exposes vulnerabilities in banks, supply chains, and global financial infrastructure. Even small missteps in policy or liquidity management can magnify risk, making the silver market a focal point for a broader market contagion. The key takeaway: extreme moves in silver act as an accelerant, revealing weaknesses that might otherwise remain hidden until a larger, more destructive event occurs. A $100 silver price before 2026 is more than a milestone, it highlights imbalances between physical supply and paper claims, exposes the vulnerabilities of banks and derivatives, strains industrial supply chains, and pressures currencies and global markets. Each chapter of this story shows that silver is not just a commodity, but a barometer of systemic stress. The key point is that these consequences often unfold quietly at first, then accelerate rapidly. Prices tell only part of the story. The real impact is in liquidity, trust, and stability. Understanding these dynamics is essential for anyone watching the market, not to predict gains, but to prepare for disruptions. Ultimately, $100 silver is a warning. It reveals what may break next, long before the broader system acknowledges it. The question isn't whether silver will reach that level, but whether you are ready for the ripple effects that follow.